Money may not bring happiness, but no one's ever complained about having too much money. I'm very excited to have in the studio Nathan Faldmo. He's a certified financial planner. He's going to help us and maybe give us some suggestions and hints on how to make more and maybe keep more importantly, keep more of our money. So welcome to the studio. Thank you for doing this.
Thanks. I'm excited to be here.
So tell us a little bit about your background. I know you were at Wall Street for a brief period of time, and now you're a certified financial planner. So tell us a little bit about your history.
Sure. Yeah. So I started off when I graduated college, went out to New York City. I figured if there's ever going to be a time for me to live in New York City, it was going to be while I was young. So,
Nice.
Before kids. So stayed there for about 4 years, a little more than 4 years, and then went to Los Angeles, partially because the weather was better, but also partially because it was closer to Arizona. My wife's from Arizona, so I knew,
of course,
at some point I was going to end up in Gilbert, Arizona.
Smart move.
Here we are.
Okay. So after that, then you started working in a financial firm. Is that correct?
Correct. Yeah.
And it's based out of Scottsdale. Tell us a little bit more about that.
Yeah, sure. So when I moved out here 5 years ago from Los Angeles, I started with one of the larger firms, and I had the agreement with them that I was going to continue to kind of look, and they were hoping I would stay with them, but I wanted to move out here, and they needed someone like me that could come in quickly. So I was able to meet a guy who was starting his own firm. I didn't know it going into the interview with him. He kind of sprung it on me about 5 minutes in. He just said, "You're hired. You just don't know what job it's for."
I love it.
And I was like, "I think I know what you're saying," but he's like, "I'll call you later on." And so anyway, he was explaining to me what his idea, which was refreshing to hear as far as the direction.
Yeah, what was the idea?
Well, so part of what he was a trader on the Chicago Exchange, and for most of his career, and then he came and ran a hedge fund out here in Arizona, and he's always been a portfolio manager, and what that means is he's been the one that's choosing the investments for large institutions. And so he transitioned over to what's called private client, and what that means is that's individuals' money, so like your money, and what he found at some of the larger firms was there was a lot of they weren't able to allow him to really manage his own investments. They had their own, and they wanted him to kind of follow their investments.
Yeah.
Exactly. Yeah. So he wanted to, his philosophy was more about, I want to be able to really hedge. If there's something going on in the market that I don't like, I want to be able to protect my client's money instead of just say, "Oh, just weather it and you'll be fine. Over the long term, it'll be fine."
Yeah, that doesn't seem to work well for large institutions. They still want you to follow their rubric in terms of investments. So you can't really extract your clients out of.
Exactly. You can't go to cash, or you can't kind of really hedge as much. And so anyway, he was going to start his own firm. And he explained that to me, and I always kind of thought that that's the way that I viewed how the investment process should be. Certainly, it depends on a person's situation, and everyone has, there's a time and a place for different strategies. But for most of the clients that we were working with, which is high net worth individuals, most of the time they want to protect their money,
sure,
and then they also want to get a return on top of that. And
that's everybody's idea, right?
Right.
Give me the maximum returns without losing my basis.
Right. We call it risk-adjusted returns.
Yes.
So we're trying to limit the downside risk, but also still capture some of the upside. And so we're willing to give up some of the upside if we can protect that downside. Especially, again, given in this market, especially the markets continue to go on a long run. And just keeps going up.
Yeah.
And a lot of it unjustifiably,
sure,
based on just looking at what should drive the market up and down. And so anyway, so I heard, without getting into too much detail, he explained that to me, and I didn't think I was going to go help start a small, startup investment firm when I moved out here. I thought I was just going to continue with the big firms. And
so you started with a smaller firm, and have you just continued on with?
Yeah. So since I've been with them ever since. Yeah.
Okay.
So
tell us a little bit about your typical client? Now, I know you used to work with the higher net worth individuals, but now you're looking to help anybody and everybody. So let's start with someone who is just starting out, like say in their maybe 30s, they just started working, they may or may not have a little bit of savings. How would you advise someone like that?
Yeah. The first thing I want to do is educate someone. So I would want to start with that person and help them understand the basics of time horizon and diversification. And what I mean by that is, stocks, if you have a longer time horizon, so 10, 15, 20 years, so someone that's younger, they typically have a longer time horizon before they're going to touch at least some of their money. You would want to be heavier in stocks. However, since stocks can go up and down a lot more than, say, something like bonds, I would, as long as you're not going to need that money for a house or for something else that you have already earmarked for your money, I just want to educate them though on understanding, okay, what role do stocks play? What role do bonds play? How does a bond even work? So a lot of people don't understand that a bond it's almost like you're acting like the bank. You're giving an entity, a government, a company, you're giving them your money, and then they're going to pay you interest. And in the end, they're going to give you all your money back. So you're not taking a lot of risk with that, but you also don't have as much potential for a higher return, especially in the long run. So
yeah, the returns on bonds are a lot lower, and you don't have as much volatility in the bonds.
Correct.
Versus stocks, you have the potential of making more money, but you have some of the downside risk of, hey, with the prices go down, then you may lose your investment.
Right.
So for someone who's younger, they may be able to tolerate that up and down volatility versus someone who's closer to retirement. They may want a little bit more guarantee on the return, on the income returns.
Well, and you said something important because you said tolerate. And so there's something called risk preference also. And so what we're trying to do is gauge how much risk can you stomach. It's one thing to say, oh, I'm young and I'm going to just stay invested for the long term. And then all of a sudden the market goes down and you act a different way than you think you're going to. And so now all of a sudden your time horizon has shortened because the market went down, and therefore you're not giving it a long time horizon. So there's kind of a little bit, there's kind of the science, but also, enough of the art that goes into the process as well.
So I learned about compound interest when I was in my 30s. I went to a course, I think by an insurance company.
Yeah.
I learned about compound interest. I was fascinated. I wish I had more money put away at that time. How do you explain compound interest to your new clients?
Yeah. So one of the things that's the most powerful for people is to see their actual situation. So I'll just tell people, even in the first meeting, I'll say, let's start right now. Let's pull up, I'll pull up the computer or put it on the big screen in my office and say, let's start putting in your income, your expenses. Let's see, what investments do you have? And let's start to look and see, okay, over time, this you can just see if the return is, say, 5%, which is pretty conservative considering the market. The stock market's been 8 to 9%, but I would rather be conservative with them in this process. So anyway, I'll show them this is what it could look like, and then that's really where I think people, their eyes open, because they can see, oh wow, like my decisions right now have a huge impact on the difference for where my money's going to go. Yeah. And what my options will be and my flexibility, or, what I want to get out of my money in the future. Yeah. So
awesome. So people of the in the last 10 years, of the people who have come to see you, what are some of the one or two common mistakes that you've seen when they finally show up and look for advice from you?
One mistake I would say is it's very enticing to see the market continue to go up. Like I referenced before. Yes, in the last 10 years, the market has basically just gone up. And obviously there's been short periods where it hasn't, but it's enticing to see that. You see the news, you're watching the news, you're talking to friends at the country club, whatever, or so you're saying, oh, well, if the market's up, fill in the blank, 20% this year, well, I want to be up 20%. And so part of what I want to help them do is take it back to what's their plan? What do they really want out of their money? Why does it matter if you get 20% right now? Because you need to understand, going back to the education, you need to understand that what you're taking is more risk by having that potential for a higher return. So you have to think about what could happen if you're invested that way. What could happen on the downside? Because it hurts worse for people to lose money than it does for the gain, of earning money.
That's a typical human psychology. We are much more averse of loss than we are excited about the potential to make money.
Oh yeah.
Yeah, which is very, very interesting.
Yeah. So just real quick on that front, there's something called behavioral finance in investments. And so you're shaking your head. So you know about this. If you were just to look at the landscape of people managing their money and the decisions they make, it's almost like we are hardwired to be terrible investors, because what happens is we see the headlines, you see the market go up, and maybe you've waited, but then it's up high, and then that's when you invest. And usually what happens is, the market doesn't go in a straight line. No. And so there's a correction, or it goes down. And then all of a sudden you see that and you're like, oh no, I better get out. Yeah, I better get out. And so
you're buying high.
Exactly.
And selling.
Investing 101 is buy low, sell high. Yeah. And now you're just flipping that up. And so the emotional component of it is hard for us. I mean, it's hard for me. Like, I'm looking at it, I'm thinking the same thing. And so it is nice to kind of take that emotional part out of the investment process, and that's part of what I help people do as well.
So what other mistakes do you think people make?
Oh man, there's a lot, but I would say part of it also is how they structure their money. And what I mean by that is, a lot of times people just look at it right now and they think, okay, so for example, I just have a joint account with me and my spouse. We have kids, but we haven't. They're not really looking at the future for what happens if one of you passes away, or if both of you pass away. So now all of a sudden, do you have everything set up? Yeah. Which is, a state attorney is typically involved with a lot of our clients, but even then, a lot of business owners, a lot of people that have been, entrepreneurs have been doing lots of things. They haven't taken the time to just set up a simple trust and a will and things like that, and get life insurance and have disability insurance. And anyway, so I would say that that's another big thing, that it doesn't matter your level of assets or the money you have. That's just a common mistake that people make.
And it seems like people are just not circumspect. Well, I think a lot of it is just lack of knowledge. Right. When I first started this journey, I had no idea about trust, estate planning, AB trust, the need for insurance, and how much insurance you need based on the amount of replacement income that may be necessary. So I had no idea until I became much more educated by my financial planner. Yeah. And it's still a work in progress, because things change throughout one's work life, even. Right. When everything's stable, relatively speaking, you have differences in income and difference in expenses and stuff like that. Now, for a lot of people, they want to minimize taxes. Mm-hmm. What kind of recommendations do you have for, like, say, the majority of people?
Yeah. So, I like to break it into buckets. So there's your bucket of money that is going to be taxed right now and will always be taxed. You have another bucket of money that is not taxed right now, but will be taxed later. And then you have your third bucket, which is, this money's never going to be taxed. And so what's important for people to understand is, how to start filling up these buckets. And so, for example, with an IRA. So if you have an IRA, you get a tax deduction when you make the contribution, typically. Without getting into too much detail, there are limits for, if you make a certain amount of income, then you won't get a deduction. And there's ways to kind of use that to your advantage that we don't have to get into now. But so you want to contribute to your IRA. If you have a 401k, you want to make sure you're contributing to that. What a lot of people don't realize is the company, if they do match, you for sure want to at least go up to the maximum amount that your company will match.
A lot of people don't understand about matching. So go into a little bit more detail regarding matching, because I tell my employees it's freaking literally free money. So go into a little bit about matching so our viewers can understand.
Yeah, sure. So a lot of times people call it's free money. That's what it's referred to often. And what that means is if you invest, let's just say you take 3% of your salary and you never comes to you, you're going to put that into your 401k so you never see it. And what happens is a company, they'll set some companies,
your employer,
your employer will set certain limits. So we'll just say your employer will give you 100% of up to 3% of whatever you contribute. What that means is if you put in 2%, your employer will put in 2% into your account, and they're not taking it from your paycheck. They're taking it from their wallet. The company is going to match you for whatever you put in up to a certain amount. And again, so if the company match is 3%, you want to at least put in that 3% threshold because you know that your company is going to be matching that amount. And so, beyond that, one of the nice parts about a 401k is you can put more into a 401k than you can into an IRA if you want to. So the contribution limits are much higher. So a lot of times if I tell people, if you can maximize your 401k and then, and again, there's certain circumstances where maybe it doesn't make sense for other
we're talking
reasons,
in
the investment
generalities.
options, but just in general, that's usually kind of a good rule of thumb.
Okay, so for typical employees, it's IRA, 401k. Let's just say if they've maxed those out, then what do you recommend that they do?
Yeah. Okay. So, let me get into that, and then I'll mention another part of that third bucket. So, the first bucket is that's the money that you're going to get taxed on. It's not a retirement account. So, just like if you were to just go to, you can go online and just go to Fidelity, Schwab, Vanguard, and open up an account that is just in your name, or you can do a joint account. But what that means is you are, when you make a trade in that account, and if the investment's gone up, you're going to pay a capital gains tax. If you receive any income from the investments, you're going to pay ordinary income rates on that investment. And so a lot of times that's usually where the bulk of people's money is, because there's only so much you can put into retirement accounts just based on restrictions that the government has placed, so that so many people don't put it in there, and then the government wants their taxes, right?
Of course.
They want to get their money. So they're going to get their money immediately when it's into that first bucket of money, which is, an individual account or a trust or a joint account or something like that.
So tell us a little bit more. So you got the pre-tax dollars, and then you got the income, and then you said something about the third bucket.
Yeah. So a Roth IRA is the most common way to have money in that third bucket. And what that means is, or the difference between a Roth IRA and an IRA is, if you put money into a Roth, you don't get a tax deduction, meaning it doesn't lower your income when you're paying taxes that year for the amount that you put in. But that money will never be taxed if you make a trade, which is the same as the IRA. But the difference is later on, when you take money out of the Roth, you will not be taxed. And so that money will grow. Not only is it taxed it's not taxed while it grows, but then once you get to a higher amount, you're not taxed while you take it out. Whereas an IRA,
it's taxable when you withdraw.
Yeah, so you might get a tax deduction, a small tax deduction up front, but then over time, you're going to be paying taxes on that larger amount. So again, it's still a nice thing to have because it can grow tax deferred, but at some point you're paying taxes on that.
I want to know how to eliminate that. And no financial planner has been able to tell me. And then the Cayman Island thing, that's already closed off. So we're kind of screwed.
In Swiss bank accounts, all that stuff. Yeah. So, there are some strategies, and so I guess one thing that a lot of people don't know that are past the income limit for a Roth IRA, there's something that's called a backdoor Roth. Does that sound familiar? Have you heard that term before?
Yes, I take advantage of it.
Sounds good.
Take advantage of it.
Yeah. So what that means is, for everyone else, it's if you're past the income limit, it's about $200,000 for married people at least. If you make more than that amount, then you cannot contribute to a Roth IRA. What you can do though is you can contribute to an IRA, and it's not deductible at certain income limits as well. So, but you're not worried about that because you're just going to move that once you put it into an IRA. About it was less than 10 years ago, the government changed the law on the restrictions to convert an IRA into a Roth, and so there used to be kind of that similar limit in place, knowing that people would, get around that. But they haven't gone back and closed that little hole up. So you can put money into an IRA and then just convert it, no matter what your income level is, convert it to a Roth. And now you've moved money from that second bucket into the third bucket, and you can let that bucket grow again, never being taxed.
So when you withdraw using the third bucket's money, you're never taxed on the withdrawal.
Yeah, and there's some other benefits to the Roth IRA, but yeah, that's the main thing is most people care about taxes. So,
what else do you like? Say you meet someone new, a new client, and now you are educating them. What will be the next step in their financial decision making, or how do they get things set up?
Sure. Yeah. So part of that education process, whether you want to count this or not, but there is a risk profile that we're trying to understand, and so there are questions that we'll have someone go through, and this is all with the intention to try and gauge, okay, how will you actually react in certain scenarios, as opposed to just what you think you want.
Yeah.
So we'll go through that, and then we'll go through. I mean, at that point, it's really just them understanding at least our strategies. So in my case, we have a few strategies that we all do, or that we just do. It's all in house. We're not using kind of other mutual funds or anything like that. So it's just educating them then about our strategies.
So that's a great point. Yeah. Tell me what is different about your firm versus another firm.
Okay. So the primary difference is we are the manager of the investments. We're not using anyone else. We'll take advantage of research that's out there, but we have an investment committee spread throughout the country of individuals that come together and make decisions on what's going into the investments. And so if someone has a question about, okay, well, why are you doing this with my money? We can get all three of the investment committee members on the phone and say, here, can you help so-and-so understand what it is that we see in the market right now? Okay, here's the Fed rates, or here's what the Fed announced. They just had a meeting in Wyoming. This is what they said. Why
try to read the tea leaves.
Yeah. So you have we have a lot of experience on the investment committee. These individuals have, they have the experience to kind of read between the lines and we're trying to navigate between all of the, what's going on in macro, the world, Japan, their rates,
large cap, small cap, everything.
Exactly. So it's overwhelming for someone who's just trying to put it all together and understand it. And again, there's a time and a place for someone to do that. But our clients, they typically don't want to handle that and want someone like us who are.
Yeah, I frankly don't have the time or the bandwidth to deal with it. And just like someone who wouldn't usually take care of their own vasectomy, right? They come to a specialist.
I would not do my own.
So to maximize your financial return, I think sometimes it's probably a good idea to consult someone whose entire life is just about how to manage finances for other people.
I'm biased, but I agree with that. Yes, I believe that.
Well, I can tell you, I was hugely educated. I'm still learning.
Yeah.
When it comes to learning on your own, I know there are a lot of websites online. What would you recommend, other than getting education through you? What would you recommend that a potential investor or an individual do to educate themselves on becoming more financially intelligent?
Oh man, there's so much information out there. I think the hard part is sifting through all of it and knowing what's good information, what's the best information,
and what's most relevant
and
for me.
What's relevant. Yeah, exactly. Because at the end of the day, that's all people care about. Why does it impact me?
Right.
So that's a hard question to answer because you could just go off what comes up, the first few articles that come up on Google, but
But
again,
the
that's
hard part
general
is,
speaking.
yeah, exactly. It's not individual.
Yeah.
Like you said, everyone's risk tolerance is different. I may be a gambling guy. So I would, even as an older person, I may want to just put all my money in more heavily weighted in the market.
Yeah.
And I may not care so much if I were to lose significant amounts.
Right.
Whereas somebody else, they may be extremely risk averse, even as a young person. So they may weigh more heavily into mutual funds and bonds and stuff like that instead of playing the market.
Yeah.
Something that I found, which is frustrating, is that a lot of women, and even in the old days, I don't know how it is now, a lot of women are not very financially savvy. I hang around physician forums, and a lot of the female physicians are, I mean, heck, it's difficult for me as a man to try to figure this out. And for a lot of women, traditionally, they just have not handled the finances. Yeah. I see a similar trend now, even in 2019, that they have a hard time understanding financial planning.
Yeah.
How would you advise maybe a woman to overcome this hurdle? I think this applies to women and men, but
yeah. No, it's something that's been on my mind, certainly increasingly over the years. I've seen over and over again that women have not often just they let their husband take care of all the investments. They might help with the finances and other components of it, but it seems like whenever it comes to the investments, it's like it's not for me. Like, you handle that. And it's something that my wife and I actually we've just started. We haven't gone live yet, but we've started a social media awareness around this topic.
Great.
So it's something that
when it becomes live,
Yeah.
let me know, and I'll put it in the video description.
Okay. Yeah.
Do you know what it's going to be called? Or?
Yeah. It's called Investing is for Girls.
Investing. Okay, great.
Investing is for girls. Yeah.
That's great. From what I read, women tend to make smarter stock picks. And they tend to do well when they pick their stocks. Maybe it's the research that they do, or maybe it's their gestalt that they have. I don't know what it is.
I think they have their finger more, they know what's going on in real life. And in the end, these companies that we're investing in, it's like, it's our kids' toys. Like, okay, what's the owner of that company, or what dresses or clothes are my kids? I know my wife, for example, she's mentioned a few times over the years where she's like, oh, like, I really like this product. Like, do they have a stock? And like, I'll go and look and be like, yeah, like they actually do. And it's like killing it, and she's like, and so, and I'll watch it over the years and I'll see like, oh yeah, that actually like has done really well. Even after she's like later on, after she's brought it up. So I don't know. I mean, I think there's a lot to it without dissecting it right now, but
sure.
There certainly is a lot of statistics that show that. Yes.
Or you can just play it kind of sort of safe and just invest in the FANG stocks.
Yeah.
I actually invested in Amazon and Facebook pretty heavily, and they've done extremely well in the last few years.
They have.
Probably some of the best picks that I made. Amazon, certainly, for sure.
Yeah. You can do that. And that's driven by, again, that's the consumer. I mean, it's the consumers are driving that, and somehow we continue to, spend. Again, Amazon, like we all have it on our phone. It's easy to, so when you understand that and you say, okay, like, how does that apply to the stock that I'm investing in? Oh, I don't see that trend changing or someone coming in and doing anything about it. So I want to invest in that stock. Yeah.
Often we may see the consumer facing side of a company, and we don't take into account everything else that is surrounding a company. For instance, Facebook is not just Facebook. Right. Google is not just Google, or parent company of Alphabet. They do a lot of things. Yeah. So what we see versus what actually is taking place in a company is not usually very apparent. Yeah. And that's why we need people who do the actual research to guide us in our investments. Otherwise, you're literally gambling with your own money.
Yeah, no, that's completely true.
I find it difficult to get people to actually do something about investing and saving and stuff like that. Do you have any tips or tricks?
Oh, for sure.
Okay.
Well, I mean, to me, it comes back to a mentality. You almost have to just change your mentality slightly. When you first start, especially, it's like that first step is always the hardest. And typically it's for people when they're younger. Maybe they don't have as much money, or they think, oh, I'll invest when I have more money. But there's so much to show. Again, going back to compound interest. There's so much to show you.
Well, I think Einstein somebody said that it's the 8th wonder of the world, compound interest.
Yeah.
Okay, go ahead. Sorry.
No, that's so I think you just have to form the habit. First of all, there's a habit that you can start saying, okay, $10. I'll give up $10 a month.
Couple of Starbucks.
Yeah, exactly. I think we can all handle that. And even if you have debt, like I don't want to just sit there and tell someone, oh, if pay down your debt first. Like, there's so many factors to look at. That might be right for someone, but it may not be right for everyone. And again, you're establishing a habit. You have a mentality that you're starting to say, you know what? I understand. Again, once they can understand and see or be educated a little bit, and you kind of have their eyes opened, then all of a sudden they can start to see the long term and how, again, what I do now is going to impact me over time. So, I forgot your question even.
Not to worry. Let's go into a little bit of theoretical. So you have folks who may be lower income and they may want to listen to Caesar or Rahman.
Yeah.
Then you have the middle class, most of the middle class. This is my opinion. You listen to late Dave Ramsey.
Yeah.
And then you have the people who are just like Donald Trump or, what's his name? Romney.
Uh-huh.
They use debt to create wealth.
Yeah.
What advice do you have for those who are just, not the lower or the middle, but the folks who are way up there in income?
My advice is,
these people are they're leveraging debt to create wealth.
Well, I think my advice is, again, don't have a hard stance on, I'm definitely going to do this or I'm never going to do this. I think you need to take your situation, look at what are the opportunities. At a certain point, there's a math to this, and then there's statistics. There's trying to figure out what's the likelihood of this happening. So if interest rates are here and there's a certain investment opportunity that's here and you can take advantage of that difference or that arbitrage, then there's an opportunity there. If you think that, okay, well, there's a 10% chance that interest rates, go up here and this opportunity stays right here, then that, you're looking at those odds. But if you're saying, well, there's probably a 90% chance that it might go up, but it goes from here to here and it's still their opportunity. So again, it's knowing what's out there and knowing your specific opportunities.
It's highly individual, like you said, and risk tolerance, and also what's happening in the market, what's the financial situation of the person.
Yeah.
And that's why I kind of stratified the three layers. So you have the Susie Ormans, the Dave Ramseys, and then you have those who are ultra high wealth individuals.
Mm-hmm.
So how do people find you if they want to get a hold of you?
Sure. LinkedIn. I'm on LinkedIn. So Nathan Faldmo.
And I will put I'll just probably put your link in the video description.
Sure.
And also your contact information.
Yeah.
You're also on Facebook.
Yeah, so I'm on Facebook. I'm trying to be better at being on there, and active. But yeah, I'm on there as well. So yeah.
Okay. And I'll probably
Instagram, I'm on the social media sites.
Cool. And I'll probably do is I'll tag you in the video description. So if anyone has any questions, they can directly message you and go from there.
That'd be great.
And if people have questions, they can maybe just leave it in the comments and then we'll just respond to them.
I'm happy to help respond and whatnot. And yes, but I don't want your patience.
No.
For your procedures. No.
All right, there you go, guys. This is Nathan. He's a financial planner. If you guys have any questions about your money or your spouse or your family's money and you need some advice, please feel free to leave the questions in the comments. It looks like, we have a lot of people watching. Bruce, Tony, Susan, Tom, Andrea, Melissa, Sashi, Christy, Nikki, Deborah, Olympia, and Symphony. Thank you all so much for watching. Have a great weekend and take care. And thank you so much for coming.
Appreciate it.